It's the State of the Union. What's the state of the economy? Welcome to a special edition of the Danny Moses Show.
Over 30 years of beating Wall Street, predicting the famous Big Short. Now, he's here for you. This is the Danny Moses Show.
I'm Danny Moses. My promise is to tell it like it is. Most weeks we only have half an hour. This time it's different. In the hour ahead, in-depth conversations with people who understand the economy better than most. In this best of edition, we will bring you some of those highlights, including why you should care about our national debt levels more than the Dow hitting 50,000, what the surge in gold prices is telling us, what is happening with energy prices, and why 3 Mile Island is back in the news, who will be running the Federal Reserve, and why its independence is so important, as well as the best ways to express themes in the markets from the vantage point of my guests and in the form of Kalshi event contracts. So sit back and enjoy. Although Federal Reserve Chairman Jerome Powell's term ends in May, it hasn't stopped President Trump from hammering him. He has nominated Kevin Warsh to replace him, but Powell will still serve on the Fed's board. But the independence of the Federal Reserve is very much in question, and it's among the topics I discuss with Cameron Dawson.
The economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative, and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
So obviously you wrote that about, but let's talk about the K-shaped economy, as we call it, and the impact. And we're going to need the consumer to keep spending, and at some point that K just stretches. Explain that, what that is, and how you see that continue.
So the K-shaped economy is effectively a way to say that there are two legs of the economy that are experiencing very different things, whether it's consumers, but it also goes the same for corporates. And the whole notion here is that the largest consumers, or the highest income consumers, are very strong, and they're driving the majority of the spending in the U.S. The stat is pretty incredible. The top 10% of income earners make up 50% of consumption in the U.S. And if you think about those high income earners, they're in a position where not only incomes are strong for them, but they also have home prices that have appreciated a lot over the last 5 years and a stock market that's been absolutely booming. So you get what's referred to as the wealth effect that also boosts consumers. And this is exactly why we are seeing this divergence between what we see within surveys, which that's effectively an equal weight. Everybody's vote counts the same. You pick up the phone to a survey respondent, or you fill out a survey online, and so the high-income consumers count the same as the lower-income consumers. You think of that consumption data, though, is very weighted to those high-income consumers, so effectively their strength is masking some of the weakness that we're seeing under the surface. So the aggregate data looks great, but there certainly is pain when you look underneath.
As long as we're on the Fed here, on the topic, the independence of the Fed is obviously very important here. I think it's important. Whether you like the Federal Reserve or not, I think it's an important thing to talk about. Powell's probably, at this point, saying to himself, thank goodness I only have 2 more meetings, because he probably doesn't want to deal with this anymore. Where should rates be potentially, or how do you think the Fed's handling this? And what is the impact if someone does come in potentially and cut rates just to please somebody, when it might just spur inflation?
So there's this concept in Fed policy making that's called the neutral rate. And you might have heard it referred to as neutral, or what's called R star. And it's effectively this hypothetical rate that exists somewhere in the ether that is neither stimulative to growth nor restrictive to growth. And the idea is that the Fed at this current juncture wants to be pretty close to neutral. The challenge is there's a lot of debate as to what neutral is. You have some members of the Fed suggesting that we are actually already below neutral, but then you have other members of the Fed, such as the recently appointed Myron, as well as people like Secretary Bessent, arguing that the neutral rate is lower, and that's how they're making the justification for much lower interest rates today. The question on what is the ramification of a non-independent Fed is really fascinating, because not only do you potentially have to have an entire board that will vote in line with what you want, so it's not just the chairman, there's an entire board that has to have a majority to cut rates one way or another. Then if you you have that control of the board, the next question is, do you commit a policy mistake? Now, a policy mistake by the Fed would look something like them cutting rates when they should be holding rates higher, or potentially hiking rates because of inflation or where growth is. A policy mistake on the other side is them holding rates far too low when things are booming. So first, you have to have control of the Fed. Then you have to have a policy mistake. The last piece of it is also important. There have to be ramifications to that policy mistake, meaning you have to see inflation start to turn higher. You have to see inflation expectations start to become unmoored, what they call unanchored. So all three of these pieces have to happen for the bond markets to really care about a lack of Fed independence, which is probably why we have seen the bond market shrug thus far at some of these threats to Fed independence.
We're in the middle of earnings season here. We're probably a third of the way through, I think, at this point somewhere. We've seen some big companies report. What is it telling you so far? And as far as earnings growth is concerned, we need to have a pretty high number in 2026 to justify, I think, where the S&P 500 is trading.
Oh man, the bar is extraordinarily high. It's like pole vaulting in the Olympics as we think about how high these businesses are going to have to be able to grow earnings just to meet expectations, let alone beat expectations. So effectively, the equity market is saying that they expect not only to have a really strong economy in 2026, but effectively a productivity boom in 2026 as well. So that creates that high bar. The other thing that's happened is that since November, the beginning of November, we've had a very pro-cyclical risk-on rally. So when we think about the different pockets of the stock market, there's some pockets that do well when things are bad. Those are your defensive type of names. Then there's other pockets of the stock market that need really strong economies in order to do well. And those tend to be things like industrials, materials, energy stocks, consumer discretionary, on down the line of things that are very economically sensitive. Those stocks, in addition to things like industrial commodities, your coppers of the world, as well as cyclical currencies, so things like the Australian dollar, have all been rallying very aggressively, which suggests that traders are positioning for and expecting a global reacceleration. So we have to watch really closely for the data to start supporting that. As of right now, we feel like the Wendy's lady who's saying, "Where's the beef?" We're like, "Where's the acceleration?" But always remember, price leads data. So the price will move long before the data comes.
Up next, Wall Street hitting records. I'll explain why it may not mean what you think. Plus, power bills hitting crazy levels this winter. Don't expect relief anytime soon. And where to look for opportunities in the markets right now. This is a special edition of the Danny Moses Show.
I remember when I first won, they said, if he gets the Dow up to 50,000 by the end of his fourth year, he will have done miracles. And we're at the end of the first year.
That's President Trump talking about the Dow passing the 50,000 mark. Right after he said it, I explained why the Dow is not a great way to evaluate the overall strength of the U.S. markets. Let me start with a little background. The Dow Jones Industrial Average made its debut in 1896 and was the brainchild of Charles Dow, who, along with Edward Jones, launched the Wall Street Journal several years earlier in 1889. It was originally comprised of 12 stocks with a focus on industrial companies, given their importance at the time. While investing in stocks in the late 19th century was common, it was dominated by the wealthy and connected financiers. It became more widespread during the Roaring '20s before the 1929 crash, which, for better or worse, cemented the Dow as the market barometer. The S&P 500, originally called the Standard 500, was created in 1957, and while it was also heavily focused on industrials, it represented over 90% of total U.S. stock market value. From its inception, the index was market cap weighted, taking both price and shares outstanding into account, unlike the Dow, which is calculated on price alone. Let me give you an example. Goldman Sachs, whose stock price is around $950, the highest of the 30 stocks in the Dow, has a market cap of $285 billion, but moves the index more than Apple stock, whose price is $270 and has a market cap of $4 trillion. A 10% move in Goldman Sachs would equate to around 95 Dow points, and a 10% move in Apple would be around 27 points. Yet a 10% move in Apple would represent roughly $400 billion in value, is bigger than the entire market cap of Goldman Sachs. One other quick example of two more Dow components. Walmart is roughly 3 times the size of Home Depot in terms of market cap, yet Home Depot's weighting in the Dow is 3 times larger than Walmart because its stock price is around $390, or roughly 3 times larger than Walmart's of just under $130. I hope that proves my point. So why is the Dow still so widely used as a measure of stock market performance? Well, the original Dow Jones & Company, acquired by News Corp in 2007, owned several financial publications, including the Wall Street Journal and Barron's, and also benefited from the creation and trading of index-linked products such as ETFs, futures, and options until it sold its remaining rights in the index to a joint venture between S&P and the CME Group in 2013. The State Street managed DIA ETF alone has almost $50 billion in assets, and State Street pays a fee to that joint venture to license that index. I don't see a scenario where either the Wall Street Journal stops talking about the Dow or the index providers stop licensing the rights. So while it might be a prestigious honor for companies to be included as one of the 30 stocks in the Dow, investors looking for proper market weight diversification should look to the S&P 500 where, you guessed it, all 30 Dow stocks are included. Still to come on this best of edition of the Danny Moses Show, continued pain from our power bills and why the explosive growth in AI may prevent it from getting better anytime soon. And the growing danger from our record-breaking national debt, why you should care, and why I like gold so much. This is a special State of the Union edition of the Danny Moses Show. I'm Danny Moses. The U.S. national debt is at a record level, nearing $39 trillion and growing every day. It was the topic of my recent conversation with my fellow Big Short partners, Vincent Daniel and Porter Collins.
The U.S. debt is high, is now the biggest expenditure on your budget. How to get out of that impasse?
Well, the big thing is growth. I mean, growth is the way. If we grow like this, we go from having a $37 trillion. We go from having high debt to low debt. But we also are cutting expenses, you know, the old-fashioned way. We have extraordinary growth. I think we're going to be growing our way out. I think we're going to be paying off debt. We're taking in tremendous money from tariffs fairly. And again, I'm using them judiciously. You know, Switzerland's a case study. I could have gotten much more. I could have asked for much more. But we're using them judiciously. But I think growth, most importantly, and then cutting costs.
Okay, my reaction to that is the debt's not 36 or 37, but what's a trillion here or there? It's approaching 39 trillion. Yes, we can stimulate growth, but I don't think we're going to be cutting much of the $1.8 trillion deficit, which I mentioned, which occurred last year. And so some of these policies, yes, can help, but when you're cutting taxes and so forth, I just don't see how this is going to happen. So guys, Vinny, I'll start with you. How do we manage this, and is it ever going to matter?
Well, the way I think about it is we are managing it, but we are managing in a way that most people don't see, right? And what we're doing is debasing the currency. And in many respects, so as the debt grows, we always ask ourselves the question, who in the world is going to buy this debt at the prices we need to buy it in order for us to continue to thrive? And whether we find real tangible buyers, let's say insurance companies or savers, or we don't, we're going to get it done by hook or crook. And the way we're going to get it done is by either printing money, and they'll use some fancy terms like quantitative easing or an algo, you know, a bunch of acronyms to explain what we're doing, or allow people, which we are doing, to lever themselves and buy treasuries and earn a small spread. Either way, the way we look at it, to keep it simple, is that they will continue to debase the currency so that we can continue to enjoy this fiscal largesse. And we'll probably get into that discussion in a bit, but all roads to us lead to gold as a result of what we're seeing.
You stole my thunder for Porter, which I'm sure he's going to mention. So Porter, why don't you weigh in on kind of the national debt and what we can do about it, if anything?
Well, Trump is right in the fact that we need to grow ourselves out of it. Where he's wrong is that we're not going to pay off debt, right? And I think in 2023 we wrote our annual letter about how the national debt is going to approach 40 trillion in a couple of years, and lo and behold, a couple of years later, here we are, right? And so that pace is not slowing down, and just the aggregate sheer size of the debt growing, is a problem. And I think that, whether that's going to be 40, 50, 60 trillion, it's not going to go down. And obviously the interest costs just compound upon that. So that's the way I see it. And listen, I want us to grow out of it. But we're going to need a lot more growth to really debase the debt out. So.
All right, other topics out there that are moving markets: Federal Reserve independence and tariffs. So the Supreme Court is going to have a hand in both of those topics. It heard the Lisa Cook firing case. The justices seem prepared to protect her, and it'll decide whether these tariffs from the president are constitutional. So question for you, Vinny. I know how we both feel about the Fed, how they handled the GFC, all the quantitative easing that needed to take place, I guess. What do you think about the independence of the Fed, and how important is it to the markets?
Oh, I'm sorry. I'm laughing as you're asking the question, because first you have to start with my view is that I never believed the Fed was ever independent. And we would argue, not with each other, but against other people all day long about the Fed's supposed independence. To me, it's a false facade to separate the spending function, which occurs in Congress, with the money printer. But to the masses, this false facade is important, so there is a risk that President Trump upsets the apple cart. And then anyone is going to upset the apple cart, as we've seen. It's going to be him. To me, the funny thing is he also wants to appoint, so he has the ability this year to appoint a new chairman of the Fed. And I know it gets a little murky as to exactly how it's going to happen, but we will, more likely than not, have a new chairman of the Fed by, I believe, May or at least the summer. I forget the exact date.
It'll be the end of May, June. So June is when the new Fed chair comes in. Yeah.
And in speeches that he has given, he has asked or suggested that whoever the new chairman is continue to lower interest rates, even if the economy continues to percolate, which is kind of unprecedented, right? That's not usually the rules of engagement for the Federal Reserve. So again, that's President Trump upsetting the apple cart. And we joke around that there's so many reasons why we keep coming back to owning stores of value and things that are tangible and things that they can't print with fiat money. And it leads to things such as gold and silver and commodities. But when you start hearing this stuff, this is how we continue to revert back to the investments that we're making today.
All right, Porter, we just mentioned the tariff, kind of the rhetoric, the implementation. It's been going on for almost a year. What do you make of it? I know we talk sometimes during the day about the markets as they're moving and pretty much buy every tariff scare, I guess, but how are you navigating that?
Well, I mean, as Vinny touched on here, one of the biggest themes in our portfolio we've been talking about is gold. And this is where it gets a bit complicated, and our background in the financial system really helped us understand what's going on. And foreign central banks around the world own a lot of dollars because it's the reserve currency of the world, right? And the thing is, they actually don't own dollars. What they own is a lot of U.S. Government debt or treasuries. And this has really worked over the last 40 years. But recently, central banks like China have started to wonder, do I need to own all this debt, right? And the subtle shift that they've made, and other central banks have made, they've decided to own an asset rather than a liability or debt. And so, for centuries, gold has been the bedrock of the financial system. And so this is sort of a slight shift and a return to what's worked over centuries. And so, that subtle shift has caused a doubling of the gold price recently. And so, we think that this will continue, and we think this is not a 1 or 2 year trade. We think this is a trade for multiple years. And so, most Americans don't own a lot of gold. They've owned the stock market, and that's been the thing to own for the last, 40 years again. But if you really look under the hood, gold's actually had a better performance than the S&P since 2000. And so we're happy to own it, and that's a big focus of what we're doing.
Yeah, I think for those people out there that aren't tracking, gold's around a $35 trillion asset at this point, if you want to add it up, and maybe even more at that point. So I guess the question, Porter, is what happens if rates start to rise as a result of the U.S.'s inability to manage its debt? I mean, that's really for both of you, but Porter, I know gold's going to go up on that, obviously, but that to me is the scary moment, right? And I opened in this episode, about that, just the debt in general, and if, to Vinny's point, if the Fed tries to lower rates in the face of inflation and people read into that, you could see rates going higher. So I guess that just adds to your gold thesis there as well.
Well, that is the scary moment. What happens if rates do up? Obviously, the interest expense on $40 trillion goes up a lot if rates go up a lot. And so you have to ask yourself, is it of national, defense importance, national importance of the whole United States to keep this debt cost low and or rates low? And I would say yes. And you've seen this historically. The Fed's issuing a lot of 2-year notes, not 10-year, because it's a lower rate, right? And Yellen did it, and Besant's doing it now. So it's bipartisan, right? And it's bipartisan. It's of national importance and security to keep rates low.
Thanks again to Vinny and Porter. Next, what's driving our electricity prices higher? Whether you own a home or rent an apartment, you likely deal with a monthly utility bill. While it might not be your largest expense, you might be noticing a decent increase over the past few years, even in non-peak usage times. Utility bills, when adjusted for inflation, have actually been tame for the last several years. So what has been the cause for the spike in rates? There are a few reasons. Depending on where you live, the construction and proposed construction of data centers as a result of the artificial intelligence boom require lots of power and put a strain on existing resources. Secondly, costs to upgrade existing utility infrastructure continue to increase. According to the U.S. Department of Energy, the electrical grid is approaching the end of its expected lifespan. Utilities now spend millions of dollars a year to maintain and upgrade their facilities. While utilities can spread out those costs to consumers over several years, they are also dealing with natural disasters like wildfires and storms that add stress to the system. Yes, utilities are regulated and prevented from gouging the consumer, but they have to pass on costs in order to function properly. Another shift over the last several years has been the reliance on natural gas. Recent data shows the U.S. relies on natural gas to generate more electricity than any other energy source. Gas-fired power generation accounted for 42% of U.S. utility-scale electricity, followed by nuclear at 19% and coal at 16%, with most of the remaining share coming from renewables. While natural gas provides efficient and clean energy, it's vulnerable to price shocks, like the one we are experiencing right now related to the massive storm and cold weather that is sweeping through the country. So what can we do about it? We have already seen a commitment from large technology companies such as Microsoft to pay for their fair share of power consumption and some of the costs related to grid expansion. We have also seen recent power auctions related to grid capacity that are being conducted by the government in an attempt to garner higher capital commitments in order to help utilities and regional grid operators like PJM, which alone is responsible for 13 states and over 67 million people, adapt to the increase in power demand. In conjunction with all of this, we are also seeing a resurgence in nuclear energy. Old reactors like those on 3 Mile Island are being resurrected, and new, smaller, more efficient reactors are being constructed after decades of negative growth and exile. The primary source of energy for nuclear reactors? Uranium. But these reactors take time to construct, and we are beginning to see the long-term secular play unfold, and uranium-related stocks are finally having their time in the sun. Nuclear power plants are now being included as part of these data center deals. So pay attention to what's going on in your neck of the woods. That was a few weeks ago on The Danny Moses Show, a place you can come to every week to get a better understanding of what is really happening in the economy and where we break down complex issues. Let's talk about recent economic data and specifically the unemployment rate. It's down to 4.3%, and I talked about what to make of it with Peter Bookvar.
Non-farm payrolls for January coming in twice expectations at 130,000. 130K, that would be the juiciest going back to April of last year when it was 158.
All right, so Peter, you do a great job of breaking down headlines like that and then looking kind of underneath the hood for what's really going on. What's your takeaway from that, just the headline number that we saw yesterday on the jobs number?
So that headline number includes government. Government actually cut jobs. So of the 137,000 came from the healthcare and social assistance area, showing again that most of the jobs are coming from sectors that are immune to economic gyrations. Whereas if you look at the more the cyclical things like leisure and hospitality, retail, financial services, information, there was no job growth there. There was job growth actually in construction, but we can tie that into data centers. And for the first time since November 2024, there was actually job growth in manufacturing, but just by 5,000 people. So when you look at this jobs number, yeah, headline, we can sound like Rick, but under the hood, it's a much more differentiated, uneven, mixed jobs picture.
And just to add to that, the unemployment rate was lower than expected also. Explain to people how the household survey and the drop of jobs, adding of jobs kind of changes that and moves that around.
So the establishment survey, the government surveys actual companies. Did you hire? Did you fire? Household survey, they're literally calling people up and saying, do you have a job? Do you not have a job? Were you hired? Were you fired? The unemployment rate is measured off that household survey. So what we saw in the January number was an increase in the household survey that exceeded the increase in the labor force, hence the decline in the unemployment rate by 0.1 to 4.3%.
Where are you seeing the best opportunities to kind of put money right now in the U.S. stock market by sector, and then maybe some specific companies if you want to mention them or not? I don't know. So,
yeah, so full disclosure, everything I'm going to say we own, and it's not investment advice. It's just telling us what we're doing. The two groups that I really like are energy, oil and gas stocks, and consumer staple stocks. Two of the most hated groups in the market coming into this year. A barrel of oil at around $60, $65 is probably one of the cheapest assets in the world. 20 years ago, oil was $60. You inflation adjust oil $60 20 years ago to today, it'd be $100. So to me, there's a lot of upside relative to the downside. And I think the downside is relatively capped. You get into the 50s, half of U.S. shale stops making money. I think the Saudis are done with this decline in oil prices because of the budget squeeze they're experiencing. So if you can buy stocks that at the bottom of a pricing cycle are generating earnings and cash flow and paying nice dividends, just imagine what these companies are going to do when oil prices are much higher. And gas prices as well. So to me, those are the most attractive areas of the market right now. But I think commodities in general, I mean, I'm going to steal Jeff Curry's line. We're seeing a revenge of the old economy. We are seeing the Gen AI tech trade outside of memory and storage is clearly running out of gas. And I think in terms of market dominance that we've seen over the many years, that trade is over. Not that these stocks can't work, not that these companies aren't great, but in terms of their ability to carry the markets, that's over. And investors need to find a new blueprint for the next couple of years.
what are your thoughts on the independence of the Federal Reserve and their role right now and how important it is in the markets and the economy?
So the Fed has never really been independent, particularly the governors that are based in D.C. They are just creatures of that city. The head of the Federal Reserve is a creature of getting calls every day from Congress and the president, maybe not physical calls, but tweets, whatever. So there's always a political situation, whether it's political donations that these members make or whatever. So with Kevin Warsh, obviously there's going to be pressure for him to cut interest rates. Whether he really believes that he should or not, he's going to. Then we shift to the balance sheet. And there was this initial reaction, we saw it in gold and silver, of the day that he was appointed, and the initial reaction was, okay, Kevin Warsh is going to be this big hawk, he's going to shrink the balance sheet, and that'll help the dollar, and I don't want to own gold and silver. Kevin Warsh is not going to shrink the balance sheet, but he will be more judicious in using QE the next time, and that the thing that you pull on the wall, only pull in case of emergency, at least right now, Warsh is only going to pull the QE in case of emergency. But that said, he's going to cut rates. There's going to be pressure on him to do it. And when things hit the fan, maybe he just does QE because everyone's going to say, you got to do something.
Next, the forces driving stocks this year and why this show isn't just about stocks and the economy. We like to throw in some entertainment as well. You're watching a special State of the Union edition of The Danny Moses Show.
The Danny Moses Show is sponsored by Kalshi.
Back now on this special State of the Union edition of The Danny Moses Show. Before we get to what's ahead for the markets this year, let's take a look back at some other predictions I've made on the show. In our first episode, I brought up the contract, will Bitcoin outperform gold in 2026? Since then, gold has continued to outperform Bitcoin, and while choosing no has been steadily increasing and now sits at 66 cents, I would be adding to that position. As we sit here today, gold is up roughly 16% for the year, while Bitcoin is down roughly 25%. That is a 41% spread at the moment. In the second episode of the Danny Moses Show, I showed a contract, will the S&P 500 finish positive this year? At the time, I said no, And while the S&P is down slightly since that time and basically flat on the year, the no contract is still sitting at 35 cents, and I do believe the market is poised for a bit of a correction, and I see the no contract trading higher from here. We bring you predictions in the form of Kalshi event contracts, and not just on the markets. This is what I said a few days before the Super Bowl. You can take the Seahawks at 68 cents, and if you just win the game, you are paid out at $1. With a penny commission, that's 31 cents or a potential 45% return on your capital. Compare that to other money lines I see being offered on other platforms at something like a minus 238, which equates to a 42% return. And with Kalshi, I can trade at much better prices and all through the game as well. Secondly, while there is a good chance that if the Seahawks win, quarterback Sam Darnold will be the MVP, I don't like his price at 45 cents. That equates to roughly plus 117. I prefer the Seahawks running back Kenneth Walker III at just under 10 cents or roughly 10 to 1 to be MVP. While it's not common for running backs to be MVPs, the last one was Davis for the Broncos in 1998. I like those odds. And as another point of reference, Walker is being offered at under 8 to 1 on other platforms. And again, if he starts the game strong, you can trade out of the contract for a profit whether or not he ends up winning the award. Another event contract I'm looking at is for Patriots tight end Hunter Henry to have 4 or more catches. I see him as Drake May's security blanket in this game, and you can choose yes to 4 or more catches for 53 cents or just over even money. Lastly, under the mentions section for the Super Bowl on Kalshi, there is a trade that you can buy at 69 cents, which I'm taking, that pays 31 cents, so effectively a 43% return after commission, that either Mike Tirico or Chris Collinsworth, the announcers for the game, will say the word wind or windy at any point from kickoff to the last play. I find it hard to believe that between the extra points, the field goal attempts, and passing, that we won't get at some point, especially since the forecast is calling for some potential gusts, that we won't hear the words wind or windy called. Oh, and there's the fact that the NBC has installed a piece of technology called Weather Applied Metrics for the game, which measures the wind inside the stadium. Sorry, I had to throw that last one in. Remember, when you're trading on Kalshi, you're trading with other users similar to buying or selling a stock, and you can jump in or out of your position at any time to lock in a profit or cut your losses. So download the Kalshi app and use the promo code MOSES to get $10 when you trade $10. Super Bowl winner, MVP, even a mention of the word wind. Yes, I missed on Hunter Henry having 4 catches, but Kenneth Walker III as an MVP more than made up for that. Up next, what's driving the markets this year? This is a special State of the Union edition of the Danny Moses Show. As we close out our final moments this hour, let's dig in on what to expect from the markets this year. It was a topic of my recent conversation with Adam Parker. What's been different than you thought? Is the market overreacting here? And what do you kind of guide investors here to kind of stay the path?
Look, I mean, after 3 monster years in the U.S. equity market, it's hard to kind of look at history and say, I'm expecting, 5 more monster years in a row. Like at some point, the market starts to discount all the amazing technology from AI. And I think that's the biggest debate is, when will we see the benefits on productivity from AI in the corporate earnings? So it came into the year with that being, I think, one of the biggest controversies, how we see the capital spending from the big companies. As we're talking now, people are still digesting Google's numbers and their huge CapEx numbers. So that's definitely one big debate. I think the second is the Fed, as you just were talking about in your show last week. What does a more dovish Fed mean for equities? So those are probably the 2 main issues. And I come out on it thinking maybe the market's got a little less upside than the consensus view. As you know, everyone came into the year really bullish, both top down and bottom up. And I think we're in for more of a choppy mid-single digit year and not like a high double digit year, just based on where we are in the cycle.
Well, there's a lot of noise in the macro that's been going on. People have kind of tuned that out to focus on earnings. So we sit here today, we're about halfway through earnings season, maybe almost, and you actually said this in your note, that companies that are actually beating earnings are selling off and companies that are missing in some cases are going higher. That's because the market likes to project what's going to happen in the future. Right. We're seeing that happen right now in technology and software as we sit here. So go into that a little bit more. And you just talked about the AI trade here. Bring that full circle here to what we're seeing.
Yeah,
right now.
I think that the software is something you want to avoid. That's been our call kind of. and the reason is we went back the last 8 times software sold off this much over like a rolling 6-month period, because it really started in the middle of last year with some of the bigger names like ServiceNow and Intuit and Salesforce, et cetera. And then you study in the past when they've gone down this much what ultimately happens, and what ultimately happens is their earnings miss. So for people to say, well, I just want to buy these things because they're down a lot and they're mean reverting, I don't know if it's that easy. I want to wait and see, how much the downward revisions are. And if you're using a valuation is so compelling, I don't care argument, some of these software companies are still not that cheap in absolute terms. If you look at like a ServiceNow, for example. So I think you don't want to catch the falling knife yet and just saying, oh, I'm going to kind of play for a dead cat bounce. I don't love that idea. I think you still want to be cautious. I think you and I are going to be able to be coding experts in 2 or 3 years. We're just going to talk to our computer and tell it what to code. Yeah. And if that's where we're heading, it creates some risk around these entrenched software companies. If you and I were CEO of a huge company, we would look and say, who are we paying lots of money to, and can we somehow fix that in a 3 to 5 year view? And I think that's why the software companies act bad, because there's some concerns about their long-term value.
Yeah, you got Anthropic with Claude, I think, is what is really causing issues here.
Totally.
And so when you look at the software stocks, just want to go back to this for a minute. Some are participating in it, and some might get disintermediated out, right? So you're seeing kind of 2 groups. You're seeing the hyperscalers and all that stuff happening. Talk about that a little bit. Just break that down just a little bit more.
Sure.
If you could.
Yeah, I think that our main view is the big companies. People call the hyperscalers the grade 8, or how people refer to them. I think you have to own at least a market weight in them. They're around 38% of the S&P 500, but if you account for their bounce or their beta.
So let's talk about that. It's Google, that's Amazon. Let's talk about people that are.
Google, Amazon, Microsoft, NVIDIA, Broadcom, Apple. If you're making a bet there that they're going to underperform, you're saying, I think that there's going to be a total shift in how the market trades. Those companies combined, the grade 8, are forecasted to grow their net income nearly 30% this year. Their gross profits are going to grow. The rest of the 492 are expected to have declining gross profit dollars. And so I think the market usually rewards gross margin expansion. So I want to own a healthy dose of the hyperscalers. I think they can buy smaller companies. They can tack on technologies, and they're pretty well entrenched. So I would rather own them than take a shot at a falling knife software business like ServiceNow or Intuit or Salesforce.com, where I'm not 100% sure what their business looks like in 2035. And so that's sort of the pair trade I like. Look, our North Star, I'm a former semiconductor analyst, as you know. I covered semis for many years, and my North Star has been, I'd rather own Taiwan Semi than Salesforce.com, and I still think that is directionally true. Dead cat bounce trade or not.
So you've covered semis, so you know they're always cyclical.
Yeah.
We've been in a secular trade kind of here, and we talk about margins out there for something like an NVIDIA, which is in the mid-70s%. We know that over the long term, that's probably not sustainable.
Right.
So when you look forward, we go through these iterations of growth and secular. When does it become cyclical, in your opinion?
So I would kind of parse semis into sort of 4 groups. I'd start with memory, where the stocks have been the best. I mean, last year, I think 4 of the 5 best performing stocks in the S&P 500 were SanDisk, Micron, Western Dig, and Seagate. So memory shortage is massive. I know that business is cyclical, and I know that because the inventory, when you overbuild, it's the most perishable, meaning the pricing goes down the most. So right now, it's short. Stocks are to the moon. I think you have to be closer to selling the memory-related securities than buying them, even if we're going to have big upside earnings for the next 2 or 3 quarters, because we're not going to pay peak multiples on peak earnings for a Micron. I think the second bucket is semi-cap, so things like Applied Materials, Lam Research, KLA Corp. I think ASML. I think those businesses may have more upside, even though some of them feed the memory business. They're not as expensive in absolute terms. Current fundamentals are pretty good, so I might overstay my welcome a little bit longer in the semi-caps. Then, as you mentioned, there's the direct revenue beneficiaries, NVIDIA, Broadcom, AMD, et cetera. And I don't think their multiples are going to expand. So if you want to own them, you're saying the growth is going to be good enough to offset multiple contraction. And then the fourth bucket, which I probably like the most within semis right now, based on how they act in the economy, are the industrial exposed companies, Microchip, Texas Instruments, Analog Devices. Those stocks are actually up a lot year to date. They're really good high margin businesses. And I think, as is typical, the stocks lead. So you saw ISM surprise to the upside. Well, we knew that based on Microchip's pre-release a month ago because they sell into those industrial end markets. So I think I'm parsing semis a little bit more than just saying, hey, it's all to the moon and it's all cyclically correlated.
So as we sit here today, the market is obviously volatile to start the year. We're probably flat for the year as we sit here, maybe up slightly. But you're seeing a rotation, to your point, out of tech. And one of the things you do well is you screen for high quality stocks and places to go, sectors that have been ignored, whether it's energy, industrials, whatever it might have been. What are you seeing right now? What are your screens telling you where people should look to reallocate if they're thinking they're going to take money out of some
Honestly,
of these
my favorite sector is healthcare. And you know, we could parse that into a million buckets, but I would just start with the big picture of we have a lot of people that are aging, they require services, tools, diagnostics, hospitals, drugs, et cetera. A lot of healthcare businesses are really low margin. And so if AI is going to help at all in predicting employee and customer behavior, it's going to help drive up margins. So I like stocks like McKesson and Cardinal and Cencora and Quest and LabCorp and Thermo and businesses that I think demand will be steady. Healthcare S&P earnings have grown every year, 25 years in a row. There's no recession in people demanding those services. And I feel like the estimate achievability is pretty good there. It's a pretty good M&A sector, and I like the fact, as you point out, it's not really correlated to the AI trade. I think that biggest issue is certainly that the government's a big customer for a lot of the companies. So it's hard to download the RFK Jr. discount as troughed or whatever, but it's certainly, healthcare was the best performing sector in Q4 in the S&P, and I think it kind of troughed in the middle of last year. Obviously that as a concern, but they were the worst performing sector the 2 years prior, creating the lowest relative multiples we've had in a quarter century. So I think my answer to that is I think it's in the price largely. And I always remember 10 plus years ago, Jamie Dimon at JP Morgan, Jeff Bezos at Amazon, Warren Buffett at Berkshire tried to create their own healthcare consortium, and then we stopped hearing about it. It petered out. So if those three guys can't figure it out, it's probably not that easy to replicate, and you're going to see probably steadier than expected demand over the next 2 or 3 years. So I like the productivity potential, and I'm not even talking about the mind-blowing stuff like faster drug development and computational chemistry and the AI, that piece. I'm just saying blocking and tackling margin expansion could drive multiple expansion for a lot of healthcare stocks. And it's certainly not the most crowded sector in the market.
Fair. One of the things I talked about on this show is the amount of U.S. government debt that's out there. And then you also have to factor in rates. How do you incorporate 10-year Treasury yields, just kind of that is the one thing everybody looks at, into your either stock screens or market thesis here?
Yeah, no, I mean, part of the reason I think I came into the year a little bit more cautious than consensus was really more the front end of the curve than the 10-year, which is, if you go back to 2022 when growth stocks got killed, the market got killed, it was all because the Fed was hiking, right? And eventually the great call was cover all your shorts at the end of 22 and get max long because the Fed's kind of almost done hiking, and I can anticipate accommodation. Part of me thinks we're 3 years later, and it's the mirror opposite now, where maybe cutting isn't going to be great anymore.
And I'm sure you run screens with yields at certain prices, and corporate debt obviously plays off treasuries, right, from the risk-free rate. So I assume you're watching spreads in that market continue, but I think it's going to be something that's going to be obviously huge focus going forward.
I think financial conditions being loose is good for equities. So what you're really saying is what makes them tighten. And it could be something in the private credit space. It could be, as you point out, a balance sheet issue. But look, we studied at Trevor really carefully the week-of-week change in the Fed balance sheet and the week-of-week change in the S&P 500, and they're really correlated. I mean, look at when the president said a month ago he might want the Fannie and Freddie to buy hundreds of billions of dollars worth of mortgage-backed securities. What happened? Every housing stock and home builder ripped higher 15% in 2 days. Even stuff like Home Depot and Lowe's, which are a little bit downstream. So I think it's hard to get too negative on rate-sensitive securities when the consensus view is the president is going to do what he can to make the economy better on housing and consumer spend into the midterm cycle.
Well, Adam, I thank you so much for coming on the show.
I love seeing you, man. Congrats on the show.
I really appreciate it. Okay, that's all the time we have this hour. I appreciate you joining me, and I hope I'm leaving you a little more informed and entertained. That's what we do every week here on Scripps News, with new episodes of The Danny Moses Show out every Friday at 7 p.m. Eastern. I'm Danny Moses.